Hello and welcome to this Astranti video. Today we'll be looking at the topic of shares. Maybe you've heard of people buying and selling shares in a business and you're not really sure what a share actually is and what the benefits of owning it are. Well, in this video we'll introduce you to the different types of shares that can be owned. This is particularly useful for those of you revising for BA1 and BA3, since this is a topic which is covered in the syllabus and may come up in the exam. This is an extract from our video on chapter 16 of the BA3 course, and if you want to see the full video, this can be found on the Astranti website, where all of our CIMA Certificate resources can be accessed for free. But for now, let's jump in and consider our first type of share, ordinary shares.
Ordinary shares are also known as common stock. As this name suggests, this is because they are the most common type of stock. So when you hear about people investing or talking about investing in shares, it's most likely that they will have invested in ordinary shares. So what are the traits and characteristics of this type of share? Well, with regards to the dividends of ordinary shares, it's key to note here that it's not compulsory to pay ordinary shareholders dividends, and this is done at the discretion of company directors. Essentially what this means is that for ordinary shareholders to make money, the value of their share may have to increase over the time. And there is no guarantee of this happening, of course, so there is no guarantee that ordinary shares will provide shareholders or investors with a return. And this partly links into the idea of risk, as do a few of the other traits I'm going to talk about in the following sections. So, ordinary shares are the most risky type of investment, and as a result, a high return is needed to cover this increased risk. If an investor doesn't receive any dividends, or if there is no evidence of the share price increasing in value, then the shareholder may simply look to invest in shares elsewhere. The next point I want to talk to you about with regards to ordinary shares is winding up. So in the event of a company winding up, ordinary shares are of the lowest priority to return an investment to investors. As ordinary shareholders may be recompensated last in the event of a company winding up, there is a real risk here that their company may have insufficient funds to repay them, and so the investment in the company may be lost. A slightly more beneficial trait of ordinary shares is that they do provide the holders with voting rights, as these holders own part of the company. Therefore, ordinary shareholders can be involved in votes at annual shareholder general meetings. This means that ordinary shareholders have a vote on things like electing new directors and also board members. The other major type of share I want to talk to you about today are preference shares. And preference shares are also known as preferred stock. And as the name might suggest, preference shareholders receive beneficial rights over the holders of ordinary shares that we've just been looking at. The first area these beneficial rights become evident is in dividends which shareholders receive. So a company is obliged to pay preference shareholders before it pays its ordinary shareholders. On top of this benefit, preference shareholders may often receive a fixed dividend from companies which may often be paid annually. The slight downside of these fixed dividends for preference shareholders is that if the company performance increases and it starts doing really well, as they are already receiving a fixed dividend, the preference shareholders don't see the increased rate of return that the company's performance might otherwise reflect. There are also beneficial rights for preference shareholders in the event that a company ends up winding up. These are that in this event, repaying preference shares is a higher priority than ordinary shares, which we've just looked at. So an investor is more likely to recover some of its investment. However, it's also important to note here that preference shares are subordinate to debts and bonds. So they are more of a priority than ordinary shares, but there are still other priorities which a company will look to repay before it then looks to repay its preference shareholders. The downside of preference shares, in contrast to ordinary shares, is with regards to voting rights. And preference shares simply carry no voting rights. So shareholders with these type of stock are simply unable to vote on key company issues in the same way as ordinary shareholders. In general, however, preference shares are less of a risk than ordinary shares. This does mean, however, that there are higher costs associated with them. In general, therefore, although the returns from preference shares are generally smaller, it is more likely that an investor will actually see some sort of return from them. Interestingly, with regards to the status of preference shares, these are seen as more of a hybrid instrument, as they can contain elements of both equity and debt. And this is something that we're going to explore a little bit further in the video going forward. So there are actually a number of different types of preference shares that an investor can invest in. And this is what we're going to look at next. So there are 4 kinds of preference shares, and we're going to run through each of these in detail, and then we're going to use an example for a fictional company called Lemon PLC to contextualize these examples in a little bit more detail. So the first of these types of preference shares are cumulative shares. And cumulative shares provide their holders with a regular dividend payment no matter what. And what this means that if for a particular reason dividends are not paid in a certain year, they accumulate and are paid in a future period. So let's take a look at our fictional company Lemon PLC to get a better idea of how cumulative shares actually work. Cumulative shares at Lemon PLC carry a fixed dividend for shareholders every year. In the first 3 years, so years 1 to 3 of a shareholder's investment, they receive a dividend as normal from the company. In years 4 to 5, however, Lemon PLC declare a dividend but don't actually pay the shareholder anything. In year 6, the shareholder receives their normal year 6 dividend. On top of this standard dividend, they also receive the dividend from years 4 and 5. So they receive essentially the cumulative dividend from the 3 years, 2 of which weren't paid at the time. Cumulative shares are in contrast to non-cumulative shares. Both of these types of shares are essentially very similar. However, as the name suggests, non-cumulative shareholders receive no payments for previous periods if the dividend has not been received. So, continuing to our Lemon PLC example, like cumulative shareholders, non-cumulative shareholders at Lemon PLC will receive a fixed dividend every year. So in years 1 to 3, they receive their dividend as normal, as the cumulative shareholders have done. In years 4 to 5, again, the company declares but does not actually pay a dividend. What this means in year 6, in contrast to our cumulative shareholders who also received years 4 to 5 on top of their year 6 dividend, is that the non-cumulative shareholders simply receive their year 6 dividend and nothing else. The third type of preference share that we're going to look at today are participating shares, and these type of shares provide the opportunity for investors to make extra dividends. And these extra dividends are generally linked to the company in question hitting certain targets. So, for our Lemon PLC example, if you hold participating shares in the company may declare that a proportion of the profits from its new subsidiary Orange PLC will be available as dividends for participating shareholders. So in this instance, participating shareholders would not only receive their normal fixed dividend, but also the extra preferred dividend received from the subsidiary Orange PLC. And this is, of course, unlike normal preference shareholders who will simply receive their normal fixed dividends. And the last of the preference shares which I would like to talk to you about today are convertible shares. And as the name suggests, these are shares which can be converted into ordinary shares by shareholders in the future. So if we return one last time to our Lemon PLC example, if a convertible shareholder decides they want to vote in the company's shareholder meetings, for instance, they can exercise their right to convert their preference shares into ordinary shares. And as we learned earlier, this of course means that they can then have a vote at the company's shareholder meetings.
So we've come to the end of this video, and you should now be able to identify the various types of shares. Want to learn more on this topic? Well, make sure you check out the full video, which can be found for free on the Astranti website as part of our full range of CIMA Certificates resources. If you've enjoyed this video, why not subscribe to one of our many social media accounts? We can be found on Instagram, Facebook, Twitter, and of course, here on YouTube, where you can find many more videos on a wide range of topics. Thanks for watching.